In this video, we will discuss notes payable from the borrower's side. So notes payables are liabilities, which we have learned are debts of an organization. Most account titles using the term payable is going to refer to a liability. And we know that liabilities are reported on the balance sheet. Now, borrowing money is a financing activity on the organization's statement of cash flows, and paying any interest related to that borrowed money is an operating activity on the statement of cash flows. Now, interest is always stated as a percentage, and we can calculate interest based on the following formula. So we take the principal amount, so the total amount of the note, multiply that by the annual interest rate, and then multiply that by the term of the note divided by 12. So this term of the note is going to be the term in months. So if it's a 2-year note, then we'll take 24 divided by 12 to get an annual percentage. Borrowing money is going to increase the notes payable account for the borrower, for the organization. And if the money is borrowed and paid back within the same accounting year, the note can be recorded on the date of issuance by increasing the notes payable liability account on the balance sheet and increasing the cash account for the amount received. On the date of payment or the date of maturity, the cash account will be decreased for the total amount of cash, so that the notes payable plus any interest will also decrease the notes payable amount for the principal of the note, and then we'll increase the interest expense account to show the use of the note or the use of the loan. If money is borrowed and the note payable is still outstanding at the end of accounting period or at the end of the accounting year, the company must prepare what we call an adjusting entry to accrue interest expense on the note. We have to show that the company has used this note according to the expense recognition principle, which we also can refer to it as the matching principle, which says that companies need to recognize expenses when they are incurred. Now, when we calculate the adjusting entry, we'll calculate interest from the date of issuance until the end of the accounting year. First, we need to record the issuance of the note, so increasing notes payable and increasing cash for the principal amount, just like before. But now, at the end of the accounting year, the note is still outstanding, so we have to show the use and record that interest expense. Or we have to show that accrual of interest. So we'll first increase the notes payable liability account on the balance sheet and also increase the interest expense, which is an income statement account. And then on the date of payment in the following year or whatever year, the cash account will be decreased again for the principal amount and the interest. Will decrease the notes payable account for the principal, will decrease the interest payable amount for any accrued interest, and then will increase the interest expense account for any remaining interest expense to be recognized. So to put this into perspective, let's look at example 1, where ABC Company has the following transactions for year 1 and 2. In year 1, on September 1st, the company borrowed $90,000 cash and issued a note payable. The note had a 12-month term and an annual interest rate of 9%. On the first of year 1, the company recognized accrued interest expense. And then on August 31st of year 2, the company paid off the loan and interest due. So this is a scenario where the company borrows money and the note payable is outstanding at the end of the accounting year. So we need to use the horizontal financial statements model to show how each of these events affect the balance sheet, income statement, and statement of cash flows. So first, on September the 1st of year one, the company borrows the cash. So we discussed earlier that on the date of issuance, the notes payable account increases and the cash account increases for the principal amount. So first, let's add in our cash asset account. We have a positive $90,000. Then we have our notes payable increasing for the principal amount as well. Our balance sheet is in balance. Let's move to the income statement. We will not record revenue or expense. This is just the issuance of the note. However, because we do receive cash, or the ABC company receives cash, we must show an increase on the statement of cash flows, or an inflow of cash, as a financing activity, as we just determined that borrowing money is a financing activity on the statement of cash flows. On December 31st of year one, the company is recognizing accrued interest on the note payable. So we need to record the interest payable and interest expense. We first need to determine how much we should record. So if we look up, we see that the interest can be calculated by taking the principal amount, multiplying it by the annual interest rate, and multiplying that by the term divided by 12. So in this case, the term is going to be referring to the number of months in the current accounting year. So we have the principal amount of $90,000, the annual interest rate of 9%, and our term in this case is starting from the date of issuance, so September 1st, and it's ending the date we record our adjusting entry, so December 31st. We have September, full month of September, a full month of October, a full month of November, and a full month of December, because we're not recording the entry until the end of December. So that's 4 months. So 4 is our term divided by 12. So we get an interest expense of $2,700 to be accrued. So to accrue this, we must increase our interest payable and we also must increase our interest expense, which we know that expenses on the balance sheet are shown under the retained earnings, and expenses also have a negative impact on retained earnings. Now we have a positive $2,700 and a negative $2,700, both on the claim side of the accounting equation. So our balance sheet accounting equation is in balance. We can now move to the income statement. This $2,700 amount we just determined is interest expense. So we'll show an increase to our expenses, which will decrease net income. And was there any cash paid or received? No, this is an adjusting entry, which we've learned in previous chapters. Adjusting entries never, ever affect the statement of cash flows because there is no cash being moved. All right, so let's move to the last event. So on August 31st of year two, the company paid off the loan and the interest due. So here, we need to decrease the cash account for the total cash paid. So that's the principal and total interest. We need to decrease the notes payable for the amount of the principal. We need to decrease the interest payable for any accrued interest to date. And then we also need to increase the interest expense account for any remaining interest. So the easy one to knock out first, which we already know without calculating anything, is going to be the notes payable. We know the principal amount is $90,000, so we can remove that from our balance sheet. Next, let's decrease the interest payable account for the amount of interest recorded to date. Right, now we get to the fun part where we get to calculate. So now let's figure out how much remaining interest we have left to record as an interest expense, and then ultimately record our total amount of cash paid. So again, we're going back to our interest expense formula, which is taking the principal amount, multiplying it by the annual interest rate, and multiplying that by the term divided by 12. So in this case, we have from January 1 through August 31st in terms of months for this note or interest expense. So that is 8 full months. So we have 8 divided by 12. Multiply that by our $90,000 principal and 9% annual interest rate, and we get remaining interest expense of $5,400. So we will increase our interest expense, which in turn decreases retained earnings. We must show the decrease in cash for the total amount of principal and interest. So that is going to be equal to the $90,000 plus the $2,700 accrued interest for the first 4 months in the previous year, and then the $5,400 of interest expense for the remaining 8 months of the 12-month term in the current year. So that gets us to a total of $98,100 being removed. So now let's see if our balance sheet equation is in balance. It is, so we can move to the income statement. Which of the amounts that we just recorded are or should be reflected on the income statement? What's going to be the remaining interest expense, which is $5,400, which decreases net income. And then we need to show our cash outflow. And we know that borrowing money in itself is a financing activity, but any interest paid related to that is an operating activity. So we're going to show 2 lines here. We'll show $90,000 outflow as a financing activity. And we'll also show $8,100, that's the interest expense, as an operating activity.